Full Employment and Price Stability by Warren Mosler. Treasury Securities and Interest Rate Maintenance. In the commercial banking system, loans create deposits as an accounting entry. Commercial bank reserve accounts at the Fed can be thought of as non-interest-bearing checking accounts at the Fed, and reserve requirements can be thought of as a minimum balance requirements. Reserve balances are assets of the member bank, and bank liabilities are assets of the Fed. The consolidated ledger for the entire banking system is always in balance, with the exception of a few operating factors, such as checks in the process of clearing. When any bank transfers money to another bank, the first bank's deposits are reduced and the second bank's deposits are increased. Total deposits in the commercial banking system remain unchanged. Figure 1. Bank A and Bank B are in balance. They have each originated 100 in loans and credited the proceeds to the borrower's checking account. Figure 2. Bank A has lost its deposit to Bank B. The banking system in aggregate is still in balance, though Bank A's reserve account at the Fed is overdrawn by 100, and Bank B's reserve account has a positive balance of 100. In this case, Bank A can borrow from Bank B. It is possible to restore balance without intervention by the Fed. If, however, Commercial Bank A's depositor writes a check to the U.S. Treasury payment of taxes, the Fed debits the reserve account of Bank A and credits the Treasury's account at the Fed. Total bank deposits in the commercial banking system are reduced, while total loans remain unchanged. Figure 1. Bank A and Bank B are in balance. They have each originated 100 in loans and credited the proceeds to the borrower's checking account. Figure 3. Bank A's depositor has made a payment to the Treasury's account at the Federal Reserve. The Fed debits the reserve account of Bank A and credits the Treasury's account at the Fed. The banking system now has an overdraft at the Fed, known as a reserve deficiency, of 100. In this case, Bank A's reserve account is overdrawn. If Bank A borrows from Bank B, the deficiency moves to Bank B and Bank B's reserve account is overdrawn. If either bank originates a new loan and creates a new deposit, assets and liabilities will increase equally, leaving the size of the deficiency unchanged. Nor will repayment of existing loans modify the deficiency. For all practical purposes, a system-wide deficiency in the commercial banking system can only be alleviated by a transfer of funds from the Fed to the reserve account of a member commercial bank. When the Fed credits a member bank's reserve account and debits its own account, total reserves in the commercial banking system are increased. In this simple case, if the Federal Reserve loans 100 back to Bank A, the banking system regains balance, beginning with the deficiency condition. Figure 3. The Fed replaces an overdraft with a loan. Figure 4. Even if Bank A did not cover the deficiency, the Fed will book the overdraft as a loan and charge an appropriate penalty. In that way, a deficiency is always covered by a loan from the Fed. The variable is the rate, and possibly the collateral demanded by the Fed to secure the mandatory loan. Should government spending exceed tax receipts, there is a budget deficit as defined for accounting purposes. Government spending is generally done via a credit to a commercial bank's reserve account at the Fed and an offsetting debit of the Treasury's account at the Fed. The credit to the member bank's reserve account is all that affects the private sector, as any offsetting transactions between the Fed and the Treasury's account at the Fed are entirely outside the commercial banking system and are offsetting entries on the government's consolidated balance sheet of the Treasury and the Fed. Let us assume the commercial banking system is in balance, with all banks satisfied with their current reserve balances as in Figure 4. A 100 payment from the Treasury to Bank B's customer is facilitated by the Fed debiting the Treasury's Fed account and crediting Bank B's reserve account. Assuming, for simplicity, there are no reserve requirements, this creates an imbalance in the commercial banking system, known as a system-wide reserve excess. Since reserve accounts are not interest-bearing, a bank with a reserve excess will attempt to loan those funds to another bank. With no other banks in deficit at the Fed, the overnight rate, known as the Fed funds rate, would fall to 0 bid. Banks would be unwilling to pay interest to attract overnight deposits that don't earn interest. Excess reserves do have value if they can be utilized to repay loans from the Fed, to purchase new Treasury securities from the Treasury, or to purchase existing Treasury securities from the Fed's current portfolio. All of these constitute the transfer of funds to the Fed. Only a transfer of funds from the commercial banking system to the Fed can diminish a reserve excess. Purchases and sales of securities by the Fed are called open market operations. The normal operating procedure is for the Fed to offset factors that cause reserve imbalances, called operating factors, with open market operations. Operating factors include any transfers between commercial banks and the Fed, and other items that affect reserve balance, including changes in unclear checks, known as float, and changes in cash in circulation. The sale of newly issued government securities by Treasury affects the private sector in exactly the same way as the sale of securities by the Fed from its portfolio of existing government securities. In either case, funds held by the private sector are transferred to the Fed. The government securities are credited to a member bank's account, and a reserve drain equal to the proceeds of the security sale results. Beginning with a reserve excess of 100, Figure 5, the Fed sells 100 Treasury securities to Bank B, Figure 6. Now, Bank B is willing to pay interest to keep its deposits, as it has 100 of interest-bearing loans and 100 of interest-bearing Treasury securities to fund. A system-wide reserve excess or shortage can only be offset by transfers of funds to and from the Fed. If the government wishes to maintain an interest rate between 0 bid, the condition coincident with a reserve excess, and no offers, the result of a reserve deficiency, it must offset operating factors that cause these conditions. Some form of interest-bearing deposits, such as Treasury securities, must be offered in the case of a reserve excess. Funds are loaned either directly, including overdrafts, or via open market purchases of securities in the case of a reserve deficiency. The Fed requires member banks to maintain minimum reserve balances known as required reserves. These do not pay interest, and therefore reserve requirements constitute a bank tax equal to the rate of interest banks must pay the Fed to borrow the required reserves, or, from another point of view, the interest foregone by leaving money in non-interest-bearing reserve accounts. Currently, the Fed enforces certain minimum reserve requirements. A reserve excess or deficiency is defined as the banks having either an excess of reserves above the required level or a reserve total that is below the required level. Technically, the concept of the Fed being the only source of net reserves follows directly from a lag reserve accounting system wherein reserve requirements are based on deposits from a previous time period. Since reserve requirements are determined by a deposit count from a previous time period and reserve accounts do not pay interest, demand for reserves is inelastic. Increasing or decreasing loans, and thereby deposits, for example, does change future reserve requirements, but cannot alleviate a current imbalance. Even with a lead system, as the U.S. had in the 1960s. Practical conditions of short-term inelasticities of bank loan portfolios result in the same Fed policy of acting only defensively in the money markets. In other words, the Fed can only react to imbalances by offsetting them. The Fed does not have the option to act proactively to add or drain reserves, to directly alter the monetary base, unless it is prepared to accept either a zero-bid interest rate or an interest rate coincident with a reserve deficiency at one or more member banks. However, as a reserve deficiency is automatically booked as a loan, the Fed's only real option is to set the price its loan of needed reserves to the commercial banking system. This is the basis of the concept of endogenous money, the major theme of post-Keynesian monetary thought. Treasury securities, therefore, function not to fund expenditures, but to provide an interest-bearing deposit for non-interest-bearing excess reserve deposits. The sale of Treasury securities supports the overnight interest rate determined exogenously by the Fed deficit spending. Without security sales from the Treasury, the Fed would create a reserve excess and result in a zero bid for overnight deposits. The economic difference between the government issuing securities and not issuing securities is the economic difference between a zero bid short-term interest rate and some positive short-term rate of interest. Consequently, the offering of government debt to the private sector coincident with deficit spending is a necessary condition for the government to maintain a positive overnight interest rate. The same logic applies to the physical printing of money. If currency is printed and spent by the government in excess of the private sector's desire to hold cash, the holders of this excess cash will be unable to find any interest-paying depositories for their cash if the government does not sell securities or offer other interest-bearing deposits. A zero-bid short-term interest rate would prevail. Without the understanding that the dollars used to purchase government securities would otherwise reside overnight in non-interest-bearing reserve accounts, fears such as rollover risk, problems relating to possibility of the government issuing new bonds to replace maturing bonds and not finding any borrowers, and financial crowding out, the notion that sales of government bonds use up money that would have been available for other borrowers, can surface and block fiscal policy options that include increased deficit spending.